All right, hello everyone. So, welcome to Finance for Computer Scientists. I'm sure we'll have a lot of BAFE students tuning in. Just know that this talk isn't geared at you, so please no smart ass stuff in the chat. We're gearing this towards basically a computer scientist that doesn't understand the financial markets, what trading is, and I'll just give an overview of what we're going to go through. So this whole thing's like trading oriented. So I want to go through the process of showing you how we would go about creating an automated trading bot, a quantitative strategy. So we'll start with first understanding an exchange, a broker, the actual contracts, the underlying, everything related to the order book, execution, etc. Beyond that, we will then go on and look at strategy identification. So looking for opportunities in the market. So when we start looking at data science, we're going to go back over some historical data and try and pick out something that might make us money. And then from there, we're going to go and backtest it using Backtrader, a Python framework that allows us to run the strategy as if it was running historically. We'll have a look at the risk metrics, discuss the risk metrics, and sort of evaluate the strategy, and then we'll have a look at the strategy that I've got up and running and a little bit of Python code I've used to execute a strategy that's currently running as we speak. This is all running on a testnet framework, so this is a Bitcoin exchange, but it's a dev net, so it's not actual real money. This could all be done on the actual Bitmex, but for now, everything has to be on the test network. So let's get started with, I guess, the screen we see in front of me. So in terms of buying, selling, how a market works, we'll generally have some kind of underlying asset. In this case, it's Bitcoin. So Bitmex is an exchange that allows you to trade derivatives, financial derivatives of cryptocurrencies. Cryptocurrency is literally just, we're going to treat as an asset. So we can buy a Bitcoin, we can sell a Bitcoin. We don't care about the fact that it's a currency. So most of the different derivatives offered on Bitmex are futures contracts. So what is a futures contract? Futures contract is a contract that essentially allows you to set a price now to buy or sell at some expiration date. So how would they work compared to the underlying being Bitcoin when we talk about that? Would be like, how would the price change? The way we'd look at, I guess, the price difference is the time to expiry and the volatility. So if we think of a normal distribution around the underlying price of Bitcoin, of its price movements, the wider it is, the wider the chance of it, let's say in a month's time, being either up 10% or down 10%. We don't know where it's going to go. So we're going to say, if we look at this graph here, let's say tomorrow that the price could either be here or all the way down here, if we can see that. All right. So the closer we get to the expiry date on a futures contract, the less uncertainty there is, because the less chance there is for the underlying to move in that time. So I guess the value of a futures contract then becomes the difference between the underlying price, so what we'd call the spot market, the price now, and this futures contract, which is a speculation on the future price of this underlying. So in terms of Bitmex, we've got these things called perpetual futures contracts, which have no expiration date. And instead, every period of time, so let's say it's 24 hours, we will get money into our account or money out of our account, depending on which side we ended up trading. So if we bought a futures contract at, let's say, $1,100, and the underlying at that time interval is less, so it's $1,000, that would cost us money. So we would then have to pay a fee of margin to maintain that position. So Another, I guess, benefit to futures contracts compared to just buying the underlying, it's like, why would you speculate on the future price when you can just buy the underlying, is that you don't have to take you don't have to outlay all the cash at once. You can just have a certain maintenance margin in your account and then hold a position that moves with respect to the underlying. So we are exposed to the Bitcoin market without actually having to purchase a whole Bitcoin. So I can explain this. So if we wanted to buy, let's say 1,000 lots of Bitcoin, or $1,000 worth of Bitcoin, the value of that is 0.1 Bitcoin, but the margin required for us to execute that, if we hit buy market, so the cost for us there will be 0.007 Bitcoin. So it's a very, I guess, cash efficient way of entering a trading position. And on top of that, we can have leverage. So essentially that's just a loan that allows us to multiply our gains and our losses. So at the moment we're set to 100 times, which is ridiculously exposed. But for just the purposes of this demonstration, we might as well just expose ourselves to as much volatility as possible. So let's explain the order book. So here in the green, we've got a bunch of people that are willing to sell a contract. We see the size, the amount of contracts available in the next column, and like the price next to it. And then above, we have a bunch of people that are willing to sell. One thing worth noting is obviously these are what we call quotes. These quotes in the market, the buys, the price people are willing to buy for down here is obviously going to be less than the price people are willing to sell for. Otherwise, you could just instantly make money. So let's say I quote in the market, I'm happy to buy for $10,376. But if I wanted to sell, I would sell for $10,306.5. But it's just changed as we go there. So if I want to engage in a trade myself, we've got all these people that are willing to buy from me here, and all these people that are willing to sell to me here. So I have two options. I can either submit an order into the market and match these people at the best bid or the best ask price. So this would be the bids. So the price people are willing to buy for, and the asks up here, price people are willing to sell for. So if I want to also buy, I could match them and put whatever orders I want at that same price, at whatever volume I'm willing to buy at. And up here, if I want the same, conversely, if I want to sell. There is risk with that though, because we have orders in the market. So those orders in the market will sit there until someone else decides that they want to buy it or sell it. So we would call this the spread. And what we're doing by submitting an order like this or a quote is waiting for someone to cross the spread. Now, if we wanted an instant execution, we wanted to buy Bitcoin straight away, a Bitcoin contract straight away, or sell a Bitcoin contract straight away, we would cross the spread ourselves, but obviously we're not going to get as good of a price as if we just submit an order. So that's something to weigh up when we're looking at trading. Do we care about this 50 cents loss? We might do. So for the purpose of this, we're not going to submit any orders to the market. We're only going to just buy or sell what's on offer in the book. Right, I guess explaining this screen, because there's quite a lot going on. You just got different tabs for different coins at the top. We've got recent trades that are in the market on the right. So this is historical trades, so of someone buying or selling. So when the price moves, you can see just this log trades and what prices they happened at. Interesting to see, not super informative for your decisions. Just the book would give you enough. And then obviously here we've got a candlestick. So if we reposition this, so I'll try and make this a bit bigger for everyone. Trying to zoom. So these candlesticks, I'll just explain what they represent. So we have open, high, low, close, and I guess volume down here. So these standard metrics of bin data. So every update we get, so these are at the moment 30 secondly, sorry, looking on the bottom. So the top and bottom of the main part is just the open price versus the close price, and then the tails either side of it are the lowest price and the highest price during the time period that they represent. So it's just binned to discrete time intervals. And from that, we can just see they'll be labeled green if the next candlestick is above the previous, and red if it's less than the previous. So a wide candlestick means the price has moved a lot in that period. So the wider the candlesticks, the more volatility we're going to see. So if we push this back to 3, so we've got actual more price movement. Zoom out a bit more. As we can see here, we go to a slightly more volatile period. Okay, so how would we trade just looking at the chart? Your key principle would be buy low, sell high, which essentially underpins all trading strategies. So what we're going to do now is we're going to go have a look at the data. We're going to try and think of different ways that we might be able to predict when things are going to go lower or going to go higher. So if we're going to predict things are going to go lower, that's the time we might want to sell. And if we're going to predict they're going to go higher, that's the time we might want to buy. So let's jump into our Jupyter notebooks here. So if we have a look at this notebook first, so we can all follow along, and all the code I have from this and all the notebooks will be on my GitHub repository after the talk. It is a bit tricky getting all the packages to work together, so I will be creating a Docker image that everyone can use that will just replicate all the different versions of libraries I've got working. But if we just initially, so Bitmex, the exchange, has an API. We're going to be using the REST API, not the WebSockets API. And there are some Python helper libraries that we're going to use. So here's just a function to download the data. So what we're going to do is download 6 months worth of 1 minutely candlestick data. So already done that pre-stream, so don't have to wait for it to happen. An annoying thing with Bitmex is that their requests are rate limited, so it takes a while to get any data if you want a large amount of requests at once. So something to keep in mind. So we've got that in a CSV, so it's saved as a CSV. So we'll jump here, read it into pandas, and have a plot. So these are the close prices. So we're just going to work with one, for the sake of this, we're going to assume the close price is obviously the close price is the most recent price we have at any interval that we would inspect. And so everything's going to be based off the close price. Just to keep everything consistent. So here we've got 6 months. Sorry, this is just five or 6 days here for this plot worth of Bitcoin futures price data. So we can see that's quite a lot of movement to go from 8,600 to 9,600, and along the way there's quite a lot of volatility. This is all around June. So, and as is typical with Bitcoin, we see quite a lot of movements in the chart. Okay, so I want to try and throw it to chat. If you already know a lot about trading, please don't reply, but what ways would you try and predict when to buy and when to sell? Can you think of any sort of methods, numerical methods you might want to use? Please say anything in the chat. I'll wait. Oh well. moving averages. That's a great idea. I'm glad someone said it. So moving averages, if reach new low buy, yep, we could do that for a window. So if we reach a new low within a window, great time to buy. We'll have a sliding window of, let's say, a day. If we reach the lowest point in that day, buy. If we reach the highest point, sell. Yep. Buy low, sell high. But when is low? That's the question. So we're going to deal with essentially a moving average. So a classic thing you might see on a lot of trading screens, or if you see those Forex gurus on social media, they might have a plot like this, and it's got bands either side of the plots. Those are called Bollinger Bands, and they're essentially just moving averages that are a standard deviation above and below. And essentially it's a very naive strategy, but we use the upper band. If the price moves above this moving average upper bound, it's a time to sell. And if it moves below the lower bound, it's a time to buy. And that just underpins our two signals, our buy and our sell signals. Now, the buy and the sell signals, I'll just hold this here as an explanation so if anyone wants to read. We've got buy and sell to engage in a trade and buy and sell to exit a trade. So we'll open a position, as we would call it, a long position if we buy. So if we see a time to buy, we'll hold that, we'll buy it and hold it until we see an opportunity to sell. So the risk with this is, let's say our moving average looks at 100 data points. And let's say we saw a time to sell early on in the moving average, and then the price just continually goes up and up and up for 100 data points. We're not going to see a time to exit that trade, and our risk may get away from us. So whilst this strategy looks nice and it's great on short term, there are plenty of circumstances where the risk can just spiral out of control. So it's just a word of caution if anyone decides to try and execute this trading strategy. It's not always a safe strategy to run. So let's plot them. So here we've got Tlib, which is just a technical analysis library actually written in C++, and this is just a Python wrapper for it. We're going to take those close values, and we're going to say the moving average time period is 100. We're going to have the upper bound, 2 standard deviations, number of deviations. That's what this abbreviation is in the variable name here, up, and the low bound, 2 deviations below. So that's within this window. And then Tlib has an option for different types of moving averages, so you can have geometric moving average, etc. So let's plot the upper, the lower, the middle, and the close price, as we see here. Let's plot. All right. Wait for that to load. And we can see the lower and upper bounds essentially dance around this underlying close price, but we can, just by visual inspection, see several areas where the price breaks out above and below. So we see here breaking out below, and here breaking out above. So these, just from inspection, this should be a strong sell signal, and this should be a strong buy signal. So we can easily calculate that. Let's do that. So here we're just going to have a look when the close values are less than the lower. So this will return a true-false array, and we're going to just multiply that by the lower price just for the sake of plotting. So we're going to hold that threshold. And here, actually let's keep it as that. we can see the cells, which is when the close value is greater than the upper band. I'm going to multiply that by the upper. And we're just going to, for the sake of plotting, we're going to replace them with NaN values. All right, and then let's plot them here. So it's going to be a bit hard to see. So what we'll do is we will only plot the cells and the close. So in cyan, we have all the cells, and in green, we have all the buy signals. So we can see plenty of them. The sequential ones we will ignore. So the first time we see a buy opportunity, we buy and we open the position. And we don't close the position until we see another sell opportunity. Vice versa, the same for if we're going to short. So if we're in a neutral position and we decide to short some amount, we don't exit that position until we see another buy signal. So I'm sure you can see there's plenty of what we'd call trading opportunities here. But if you have a look, there's plenty of buy signals here that have gone on the way down. So these trades would be marked in as losses, since the difference between buy and sell is lower. All right. So now we've got a simple trading strategy. Let's try and backtest it. So backtesting, as just a terminology, is literally just stepping through your data as if it's current and testing this strategy, this hypothesis that we've got, and marking in potential trades that we would have engaged in at that time. So really simple, we just look at a window of data and we only ever look historically, and we pretend we traded and we mark them in as profits or loss, and we see whether we would have made money. So the idea behind it is just to sort of log the performance over time, and then we can look at the statistics of our performance and see sort of our risk exposure, our profitability, and anything we might want to change. So what allows us to do that is this backtrader library, which essentially just allows us to define a state machine, and this state machine passes over this historical data that we will feed it. So here we define the strategy. So the moving average, this is moving average period, so these parameters, we're going to say is 200. The standard deviation factor, so the deviations above and below, we're going to say is 1. The size that we're willing to trade, that's the size of the underlying. So we're going to only ever trade, in this case of the strategy, half of the value of one Bitcoin. So let's say Bitcoin's worth $10,000, we will only engage in a $5,000 trade each time. So ignoring this log function, so we've got just in terms of this strategy class, this extends this backtrader.strategy. So it's got a few functions in here that allow you to make it work with the underlying backtrader functionality, which is defined further on, but I'll just explain the strategy further. So we've got an initializer, which just initializes a signal, these Bollinger Bands, with that period and the deviation factor that we've defined. And here we've just got, for ease of use, the data close. So this just defines a way of defining the most recent close price, so we can access it anywhere in this class. So next function is essentially what's stepped every time. So backtrader, when we run it, will call .next, and it will time step through everything. So here we check for we have this backtrader broker. We check, do we have any open orders? And so if there are open orders, we'll cancel them. So these are orders that are theoretically in the market. Next, we'll check if we don't have a position. So if we don't have a position, we are neutral. We check to see if the close price is above the top Bollinger Band, and then we sell. So now the decision of how much we sell is just fixed in this example. So every time we're only ever going to trade a half size. And exactly the same, if the date of close is less than the bottom line, that's a buy signal. So we'll engage, we'll open a position here. Now here, if a position is already open, we check if we want to exit it. So we check it here, this is just a way of checking if we're long. If we're long, we check, is there a sell signal? And if there is a sell signal, we execute a sell order. And all these are just market orders. Because we can only trade what's in the book, because we can't actually go back in time and submit an order. Modeling that becomes quite difficult, so we're just going to take whatever's quoted. So we just take market price. Same here. So the price that we're going to just mark in that we can execute at is the close price each time. So each time we do this theoretical sell or buy order, we're going to say that the price for that is the close price, the most recent price we have available. Okay, here we just got some printing. So this just prints out when the trade has occurred, gives us some information about it. All right, next. Just defining the data feed. So here, this is just defining where in the CSV. So if we go here and have a quick look at the data, it's just raw CSV. We've got all these different columns that represent low, open, turnover, so all this information. Foreign notional is just the different price available in the notional amount available in the market in Bitcoin, and home notional is the amount available in USD, in US dollar. So if we head back, we'll keep looking. So after defining like which column is which, we'll go in and we'll create I guess the state machine for Backtrader to be able to run this strategy that we've defined. So we create a Cerebro, which is just what they call this sort of, I would call it a runner, that runs the steps through the state machine. Here we create a data feed just from the CSV data. We say use everything that we've got that's in 2020 by setting the start date time and the end date time, data path, which is just this one. So after adding the strategy, this one, into Cerebro, we then go and add the data. We can ignore the add sizer. That tells us how much we want to size into a trade. It's not really used here. We add an analyzer, so this is essentially what's going to give us a summary metrics at the end of the run. We set how much starting cash we've got, so we've got $8,000 in the cash in the broker account. And then here, it's just a quick way to penalize making too many trades. So this isn't based on the actual Bitmex fees, but we say here that for every trade, there's a $2 commission. So every time you buy, every time you sell, it's going to cost you $2. Here, we're running with a contract multiplier of 1, and margin, considering we've got a contract multiplier of 1, isn't necessary. So print out the starting portfolio, we'll run. So let's run it. So here we can see all the trades that it is theoretically entering and exiting. So this is, once the position is closed, it's logging the P&L, the profit or loss, for each one. So we see here it made $13.25, here it lost $3, here it made $23.50, etc. So on and so forth. So we started with an $8,000 cash balance, and with this strategy, we have made, in this 5-day testing period, $652. So it's quite good. Here we can plot. I might have to restart the kernel to get the plot to work. But here, what it will do is it will plot every time we bought and sold, so we can inspect. this again. So end up with the same value. Right. And here we have a plot that Backtrader outputs. Just wait for it to display again. Okay, so we can see here, the green is a buy, the red is a sell. We can see here all the trades. So this little dot, these dots up here. This is just all the trades that are entered in over time, and the height of that is just determined by how much profit or loss each one made. So you can see the majority of trades are profitable, but the few trades that we do make that make a loss make quite a bit of a loss. And then if we have a look up here, we've got the cash balance. So we can see why the cash balance drops down beyond what we have in the broker account every time we have an open trade. So cash balance here. So majority of the time we are in a position, and we see that gradually over time, especially in the last part, we make money. So yeah, the signals are also plotted on this just for convenience, so we can see when it decides to buy and sell along with these different breakout areas. All right, so let's rerun it, but over 6 months worth of data. Let's see how much money we make. So I'll just swap the CSV, just this one. Let's run. Okay. Just takes a while to run, so in the meantime, any questions in the chat? All right, we're trading. Callum B, is this where you make stocks? Yeah, this is where we make bulk cash. So we've just made, in this 5-day testing period, $600, which is quite good. Will this be uploaded to GitHub? Yep, all of this will be available afterwards. I do want to clean it up and make sure the Docker image is working before I do that, so it won't be straight away. Yeah, so in this 5-day testing period, we made $600. Testing over 6 months might expose us to some periods of time that we might have lost a lot of money. So it's the more data that we can test on, the better. But there is a point where if we look too far back, so let's say if we went 5 years back or even 10 years back, the Bitcoin price, it's really not indicative of how the market moves now. How easy is it to add new strategies to a system like this that's already set up? Good question. So you would just write yourself a new class. So here we've got just a test strategy class, and everything essentially happens in this this next function. So essentially everything here is where your buy or sell logic happens, and that's all based on indicators, but you could also at any point you could access, like, let's say 500 data points back or 100 data points back just by using the .datas. At the moment we get 0 because 0 is the most recent data point, but we could even use some machine learning and then have an input of, let's say, 500 most recent data points and get some kind of prediction of either price, or we could even have a classifier to buy or sell and use that to inform our execution in the market. So yeah, essentially the only thing that you would need to change here is the strategy. And then to answer the question, if you were to tweak this trading on regular ASX trading, what would it require? So the reason I've done this on Bitmex is because it's quite easy to get access to an API. To get access to an API that can trade in an actual stock market, you would need a broker that offers an API, and there's not really that many that do. The one I do know of is Interactive Brokers, but to open an account with Interactive Brokers, you need $100,000 net worth and like $5,000 minimum cash balance at any point in time. So for most people that would be out of reach. If you're fortunate enough to have that much money, go for it. Start incorporating the API endpoints to the bot that I have running. I wouldn't recommend it, but it's up to you. Next question would be, is the bot safe for real Bitcoin trading, or should it be regarded as a prototype model? I mean, no bot is really safe. In terms of execution, that would be my biggest worry, would be judging how safely it would, like whether it would break. So it's running as a Python bot. Like if it breaks, then you can't exit positions, you can't enter positions, you've just left yourself exposed to the market. Beyond that, writing an execution logic for when to hack, hacking being if a position just starts to fall away from you, you need to just cut your losses there and then and exit the trade. So we'll see in a bit when we look at our risk metrics, we'll set risk parameters for which we're happy that things to stay within. So for example, when we buy in the market, we don't buy at the very bottom because that's almost impossible. We buy on the way down. When we buy on the way down, the position we have marked for a period of time, we're going to make a loss. So we might buy, let's say it's Tesla. Tesla's dropping from $400 down to 300. We might see a good buy signal at 320. For a period of time, we've lost $20 per $320 contract before it bounces back up, and let's say it goes back up to 420. So just defining your risk parameters, which I'll show you in the next step, using PyFolio is the best bit. So essentially tweaking your backtest till you get some acceptable level of risk depending on what funding you have available. And then so long as you've got a solid execution, I would personally say that you'd be fine to run it. I mean, I'm no financial advisor, so you can't take any of my advice, but yeah, for all intents and purposes, that's the whole point of doing this backtesting, is seeing the risk associated. So, I don't know if anyone saw, so after running, we ended up with, from an $8,000 account, we ended up with $16,729. So we made 100%, more than 100% return on our initial $8,000 cash balance. And that's with only ever trading a half contract amount. So we could have started with a lower cash balance because I guess the cost to enter a position is at any point, let's say Bitcoin's never been above $10,000 in the last 6 months, the cost to enter any position was $5,000. So if we wanted a minimum cash balance, we could just stay with $5,000. And this is without considering leverage. So let's have a look at some summary metrics. So Sharpe ratio. This is generally what we'd use to sort of judge a strategy. But Sharpe ratio as a single metric is not as good as, I guess, Sharpe ratio over time. It's our risk-adjusted returns, so how much money we made compared to how much risk we exposed ourselves to. So the more volatile a strategy, the more returns we would want to expect from it, because at any point in time we might be down in our cash account, and then tomorrow we might be up. So the goal to get high Sharpe ratio is to get high returns and low volatility or low risk. But obviously there's a certain amount there. There's a fine line to walk of a risk-return ratio, and we sort of denote that by Sharpe ratio. So here, 3.52, that's above the threshold of what most people would consider an executable automated trading strategy. So this would, in the simplest form, pass the test to, yep, we're happy to start executing this. If we look at annual volatility, so this is 30%, to be expected on a Bitcoin strategy because the underlying is really volatile. But that is quite high. So again, that's risk. Annualized return is 176%, which is very good. So here we've got things like Kalmar ratio, which again, just a risk representation. Max drawdown. So this is probably our most important one. So this is the maximum amount we allow any open trade, or that we see any open trade drop. So we will open a position at, let's say, $100. The maximum amount that it has dropped that we've seen in any trade we've engaged is 7%. And that's just in the period of holding. So it might drop to 7%, but then we might exit the position at 102 and mark a $2 profit. So we would use this as essentially our decision when to hack. So if we've got any position open and it loses, it's dropped more than 7%, or it's gone up more than 7%, and we're short, that's when we hack. That's when we say, right, cut our losses, that trade is no longer worth chasing. So we look at here, we can see the skew, kurtosis, which are just how, essentially telling you how normal the distribution of profit and loss is. We tend to see log normal rather than normal, just from the geometric nature of price data. Things tend to move in percentages rather than in single dollars, so obviously things will move, will go down 1%, it takes a lot more to go up, that's 1%. Alpha and beta, since these aren't stocks, we can't really compare them to an index. All right. So we've got here, worst drawdown periods. So these are the least profitable periods for us to trade. So late January, early January, just January in general, it seems, was pretty bad. 4 and 3% drawdown, which really is not that bad. And our worst drawdown period was in May of 7%. So whilst our max drawdown was 0.07, that was only for a very few amount of times. So if we have a look here, this is our cumulative returns plotted against the S&P 500. So I'm going to try and zoom out a bit. Try and make this window bigger. No. Well, we'll just have to deal with scrolling through the plot. So here we just see our percentage returns over time compared to if we invested in the S&P. So this year particularly, quite interesting. So obviously in March we saw that big dip, and we're only now around about the same place we were in January. However, if we'd executed this theoretical strategy, and remember there is still some other risk here, we would have made more than 2 times our money. So running a Bitcoin bot is a better bet than investing in the S&P, which is essentially what we want to do. So we have generated alpha, as they say. All right, I'll have a look at the chat. What strategy should be adopted for equities or gold commodities according to you? That's such an open question. So I'm trying to show you how you would look for a strategy. I'm not going to tell you how to trade. The idea is that you would go use some data science skills, try and have a look at the data. Go get yourself some gold data or equities, whatever you want to look at buying or selling, and try and come up with some signals, some buy and sell signals, and then run it on backtester. Just trial and error. Just keep trying for signals, seeing if you make any money on the backtest, and then have a go at executing it. For the periods this backtest is over, how much would have been made if someone just bought at the beginning and sold at the end? That is a great question. So let's compare that. So I don't have that data anywhere here. So let's have a look in Explorer. I'll just ingest it and then read the top and bottom. Very good question though. All right. Sorry. Right, so that's the earliest data. And this is the most recent. So we've gone from 7. This is just inspection. If you just bought in January 7,000 and sold, you've made $2,000, whereas in the period our bot had, we've more than doubled our money. So I think we've done a better job. Right, back to the backtesting. Any other questions? Any good sources or books where we can learn in depth about trading algorithms or the strategies themselves? Yes. So I would recommend, I guess there's your simple traditional strategies. You could probably just look at online resources, but if you want to go in depth, I would recommend Marcos Lopez de Prado. He has 2 books, Machine Learning for Portfolio Construction and Machine Learning for, I guess, for trading. He's considered probably one of the best for data science and trading. So there is a bunch of his stuff available free online. There is a GitHub available from someone that's decided to do an open source hedge fund that have created Jupyter notebooks for every single example in that textbook that he has. So if I was pointing in the direction of a resource, that would be it. All right, how did I learn how to develop financial bots? Are there any resources? So I, about a year and a half ago, started an internship at Vivian Court Trading. It was a trading internship, so spent 7 months in Sydney learning trading, writing models for trading and for market making. And since then, after that 7 months, I've been working part-time as a quantitative analyst, doing essentially the same kind of thing. So looking at the statistics of strategies and strategy research. So that's how I learned. Marcus, I'll spell his name. This is it. Let's have a look at his books. Yeah, so Advances in Financial Machine Learning is probably the one I would recommend. And then Machine Learning for Asset Managers is a newer one. He's written a lot of papers on high frequency trading and market making. He's probably the highest quality research you will come across on this sort of topic. So do those values factor in fees? Great question, Nick. So in terms of fees, we've just said that fees are $2. So we could up that, say worst case scenario, fees per trade are $10, and we'll rerun, and so we'll just leave that in the background. And see how that returns. But yeah, it does somewhat account for fees. They're not accurate though. So CB Tom, say you've designed what you believe to be an effective trading algorithm. How do you use this to advertise yourself to trading companies? That's a big question, I guess, depending on, are you trying to market the strategy to the trading company, or are you trying to market yourself to the trading company, trying to get a job there? If you're trying to get a job there, just creating a strategy that works on these kind of volumes is a lot easier than what it is when you're working at scale. So right, next question. What steps are carried? Can you explain a little bit more? Yeah, so we have the next bit. So whilst we've been talking, I've had the bot running in the background, so I will show you the code. Sorry, the computer's running quite slow, especially with ZSH. this tab. All right. Is that font size good for everyone? Okay, so this will all be in this repository. It's currently private because I need to remove some keys and whatnot. But let's look at the overall structure. So we've got 3 main files. This main loop, which is literally just a loop that every minute makes our decision: do we buy, do we sell, do we exit trades, or do we just stay as we are? So let's have a look. Super simple. For the sake of it looking nice, because it's a super naive bot and the code's a bit messy, I have suppressed warnings. That is a bad idea. Don't do that if you want to run something yourself. Yeah, so just a quick warning there. But all this does is it creates a client using the Bitmex API, essentially sets up using the keys that you'd get on the API tab up here. We can see it's sold a contract there. So yeah, we just use our keys, which are stored in a config.py, which I'm not going to show because I don't want to show API keys on stream. And then we have these classes that we've written. So this strategy class, which defines our strategy, which essentially just, given the data, will predict, do we buy, do we sell? And then the trader, which this is where all the execution happens. So to have a quick look at the API, I have some code just in here. And so we can open and close trades using this. So this is block of code here. If we run it, this gets our cash balance. So this just gets our account information from the exchange. So the moment we've got 0.0074 Bitcoin available. In total, we've got 0.0079, so that includes stuff that's wrapped up in an open trade, so in margin. So if we want to make, if we've got 100 times leverage, we only have to hold 1/100th of the value of the contracts bought in margin. All right. And then here, this is what we use to get the data. This just gets us our open, high, low, close, volume data. Reverse is set to true because we want, at the top, we want the most recent piece of information. So this is what will get called every minute and fed to our decision making. So we have a look here on that data, we can see close value, middle band, upper and lower bands. All right. So here we can submit an order. So what we're going to do is we're going to use the API and submit an order for, so we're going to set the price, which means that it won't be a market order, it will be sent as a quote. We are currently at 10,300, so we're relatively safe to send one of these because we know it won't get filled, just so I can show you what an open order looks like. So here we go, and then returned is the open order. So now if we look here and scroll down, active orders, we've got these orders open in the market. It's a limit order, which means it's submitted as a quote, so we won't execute unless we hit this price. Obviously we don't want this, we don't actually want to engage in this trade. So what we'll do is we'll go back to our code and we will cancel all orders. All right, so all orders in the market have been cancelled. We generally have this on our bot in the event of things going awry, so we don't want a stale order in the market that we thought was a good purchase price, but if things drastically drop, we want to pull that so it doesn't get filled. So we can see here, cancelled. All right, so this will sort of give us the idea we can get the information, we can execute a trade, we can cancel the trade. So let's go back to the bot. So let's have a look in strategy. Looks very similar to the code that we had before. In the backtesting, it uses the same logic. There's a bit of extra information here just for the sake of making it easy to work with. So the client, which is just defines which API the API endpoint, initialize all these these like most recent values. This is state values. We initialize them to 0. Timestamp initialized as 1. There's none. Here we set the time frame, which is what's sent in the request, which is the size we want to bin the data. So 1 minutely is available as the sort of like the most smallest amount. Next would be 5 minutely. Beyond that, you can go half hour, whole hour, days, etc. If you wanted more up-to-date data than that, if you wanted to get the order book state as often as it is updated, you'd have to use the WebSockets API, not the REST API. Right, so when the strategy is created, we've got this is instantiated, and then when we call .predict, it will get the most recent data from the API. We'll get row, which will allow us to set all of these most recent values. We'll print out the market state, so the open, high, low, close, as well as the timestamp, so the time of the most recent data point. Here, this is it's an old signal that isn't going to be used anymore. Just comment that out. But here, this is where we just find the upper band, middle band, and lower band of the Bollinger Bands using the TA library, the technical analysis library. And the same, the parameters are set at the top with the period that we want that over and the standard deviation factors. So here we are essentially just sending in the values. This should actually be reversed. So what's executing isn't ideal, but you know what? This is just demonstration. And then we print our our signals, so we can visually inspect when and why we decided to trade. So we'll quit that. Right, so if we have a look at the trader, this is where all the execution happens. In the initialization, we just set all these parameters that we're going to send to or from the exchange. And then we just have this execute trade thing, which is called on every loop update in main loop.py. So we get the prediction. So if we quickly have a look in strategy.py, the predictions here, the sell signal is a -1, a buy signal is +1, do nothing is 0. So we use that to inform here. So we get the prediction, which is -1, 0, +1. What we do is we try updating. This is just because the API endpoint can fail. Any current open positions we have. That's a really hacky way of doing it. I just did it to get it working for demonstration. We define open position if a position is open. So this has a bunch of information it sends back, and if it's open, this parameter is set as true. And exposure, which is how much we are long or short. So we might be 500 contracts long, 500 contracts short. For the purpose of this bot, we're only ever buying 500 contracts, and one contract of these perpetual futures are $1 worth. So they're $1 worth of Bitcoin futures. So it's quite an odd way to sort of set your contract size, but when we're buying 500 lots, we're actually buying $500 worth. So that's how that works. All right. So in the execute trade, if we've got an open position, we use this to print it out, so it looks quite nice. And then here, if the prediction is sell, so this is if the position is open. If we've got a sell prediction and our exposure is greater than 0, so if we are long, close the position. So that's we've been given an indicator, now's a good time to sell on an already open bought position. And then the same here, if the prediction is to buy and we are already in an open short position, we'll close that position. All right, else we'll print no positions open, and then we will check, do we want to go long and do we want to go short? This is where we open our positions. And so get position here, which is what's shown in the update. This just gives us information about our position. It'll show us how much money it's making at one point in time and vice versa. And then here, this is just the helper function. Close all positions, here execute the trade. And it'll print out, we are buying this amount. So in this window, this is where we've got our currently running bot. And so we can see it currently has a short position on, as we can see here, of minus 500 contracts. This is on 100 times leverage, so the actual amount of margin used for that is $5 worth of Bitcoin. So we can see the amount of margin here. So entry price, this is the price at which we shorted at. And then here we've got our last price, or a mark price. So that's the current price in the market. And then down here, we've got some quick calculations. So we've got our future P&L. So this is if we held until contract payment date. So this is our difference. So we've got a future return on equity, which is our return on our amount of margin we have, not the amount of the $500. So we scale it up in terms of our profits and our losses. And then we've also got our marked P&L, or our marked return on equity, which is marked in the market. So if we were to sell at this point in time the contract, rather than holding it till the expiry date, this is the return we'd make. And so if we have a look at our marked return on equity at the moment, we are 84% up. So in the last minute, we've gone from 4% down to 84% up. So that's at the moment, a great trade to be holding on to. So if we have a look, entry price at 307, marked return on equity 84, our close price up here is 10,214. So we entered at 307, and then we could, if we exited now, close out with, what's that, about $83 profit, but we only had to put $5 down. So that's $83 profit on the 10,000, so we would divide that by 20 to actually get the amount we traded. So $85. Oh, so it looks, we've closed the position. Great. So that $85, if we divide that by 5, or by 20, we'd get about $4.50. So we've made we made 84% return on our initial equity, which is good. So, any questions about any of this information, because there's quite a lot going on here. Leverage obviously makes us able to take more advantage of small movements in the market. Okay, so we have gone from closing a position to going short again. Nice. So we've got another position open. Currently market return on equity is 36%. So questions. Why would you prefer limit over market? Strictly for profit basis or anything to do with comply with the strategy? So the spread at any point in time is usually 50 cents. So it's going to cost us, so there's a 50 cents difference in a perfect scenario of us either submitting a limit order that gets filled straight away or as executing in the market. When we're taking such small amounts like this and trading so regularly, 50 cents is quite a large portion of these small profits we're taking. So a limit order, would be advantageous, but obviously your risk is execution risk. You've got to wait till someone thinks that's also a good price. So you can you could set a limit order that's higher than the currently quoted. Let's say there's a $1 spread and you submit 50 cents better bid or offer. That's more likely to get filled straight away. So yeah, that is an effective way to trade, but quite often we'll have market makers keeping that as tight as possible, and they make the spread. That's how they make money. Okay. Questions? Do we want to try some live coding? Anything? What advantages does Python have over other languages? Python is just great for data science, so having access to all those libraries. Latency wise, it's rubbish. So if you want something that's latency sensitive in terms of a strategy, don't use Python. Go write it in C++. Other than the Bitmex API and Python tech, what tools and technology have you used for making this bot? Other than the Tlib and the Bitmex API, it's just the rest is Python. Yeah, I guess we can wrap it up there. That's my talk. That's my presentation of this crypto bot. I'll have the code up and online as soon as possible. I'll be posting it on Slack, the link on Slack when I have it. So make sure you're on the UQCS Slack for those BAFE people that aren't. Make sure you join UQCS as well whilst you're at it. Yeah, thank you.
Now James is going to tell me if I'm in frame. I've got to move this way. We're keeping COVID safe. Big thank you to James for coming along and putting all of that time and effort into making that demonstration for us. Hopefully you've learned something. I know I certainly did. As a token of our appreciation, as always, very own UQCS mug.
Thank you.
Thanks for watching, everybody. We will see you next week.